Imagine getting a $5,000 raise, celebrating with your friends, and then discovering you actually owe more money at tax time than if you'd turned the raise down. Not because you spent it, not because of some mistake, because of one invisible line in the tax code that nobody warned you about. Now I'm going to show you exactly how this happens, the 3 sneaky thresholds where it triggers, and the one move that can save you from it. But first, you need to understand what tax brackets actually are, because most people get this wrong. Here's the scenario. Let's say you're a single filer and you make $45,000 a year. In 2024, that puts you in the 12% tax bracket. Now your boss offers you a raise to $48,000. Congratulations, right? You just crossed into the 22% bracket, and here's where panic sets in, because most people think this means all $48,000 now gets taxed at 22%. That is not how it works. The United States uses a progressive tax system, which means only the money above each threshold gets taxed at the higher rate. So your first $11,600 is still taxed at 10%. The money from $11,601 to $47,150 is still taxed at 12%. Only that last $850, the amount over $47,150, gets taxed at 22%. That's it. $850 times 22% equals $187 in extra tax on the extra income. You still come out ahead by thousands. So the idea that a raise can somehow cost you money, that's a myth. At least when we're only talking about tax brackets. But here's the thing. And this is what I promised to show you. There are hidden cliffs in the tax code where earning one more dollar genuinely costs you. Not because of the bracket itself, but because of what triggers when you cross a threshold. These are called phase-out cliffs, and they are brutal. Let me show you the first one. If you're a millennial trying to be smart with your money, you probably know about the Roth IRA. In 2024, if you're a single filer, you can contribute the full $7,000 if your income is under $146,000. But here's the trap. Between $146,000 and $161,000, your contribution limit phases out. Earn $161,001, you can't contribute at all. Now think about what that actually costs you. If you were investing $7,000 a year over 30 years at an average 7% return, that's potentially over $660,000 in tax-free growth you lose because of $1, one single dollar, the second cliff. If you're paying off student loans, you can deduct up to $2,500 in interest from your taxable income. This deduction starts phasing out at $80,000 for single filers, and it's gone completely at $95,000. Let's do the math. The $2,500 deduction in the 22% bracket saves you $550 in taxes. So if you earn $95,000, you get that $550 benefit. But if you earn $95,001, it's gone. Completely. So if your boss offers a $500 raise at that exact income level, you gain $500 in income, but you lose $550 in deductions. You literally lost money by earning more. And the third cliff. This one is the nastiest. If you buy health insurance through the Affordable Care Act marketplace, your subsidies are based on income. In 2024, if your income is at 400% of the federal poverty level, which is about $58,000 for a single person, you qualify for premium subsidies. These subsidies can be massive. We're talking hundreds, sometimes thousands of dollars per month. But here's what happens. Let's say you're getting $400 a month in subsidies. That's $4,800 a year. And let's say you pick up a side gig that pushes your income $1,000 over the threshold. You earned $1,000 extra. But you just lost $4,800 in subsidies. Your net loss? $3,800. You worked more and got paid less. So what do you do about this? How do you protect yourself from the hidden bracket jump? 3 practical moves. First, know your magi. Modified adjusted gross income. This is the number the IRS uses for most of these thresholds. It's not your salary, it's your income after certain adjustments. If you don't know this number, you're flying blind. Second, use retirement contributions to lower your magi. Money you put into a traditional 401k or traditional IRA reduces your taxable income. If you're near a cliff, increasing your retirement contribution can pull you back to the safe side. You save for retirement and avoid the trap. Win-win. Third, if you're self-employed or have a side hustle, time your income. If you're close to a threshold in December, you can sometimes delay invoicing until January or accelerate deductions. Tax planning isn't about what you earn. It's about when you earn it. Here's the big takeaway. The tax code is not designed to be intuitive. It's full of hidden cliffs and phase-outs that can cost you thousands if you don't see them coming. But now you know. You know that a raise isn't always a raise. You know that $1 can be the difference between saving $660,000 in tax-free growth and saving nothing. And you know the 3 moves that protect you. Remember that $5,000 raise from the beginning? The one that felt like a trap? It's not a trap if you see it coming. It's just a puzzle. And you just got the cheat sheet. If this was helpful, there's more on the channel.